Hi everyone, Friday, September 16th. Welcome to Three Things with Spyglass Lending, where we peek a little bit further behind the curtain with what's going on in the mortgage industry, right? Not the usual stuff you see in the headlines, not the fluff. We are delving deep. Let's get right to it. Number one, REOs and short sales. Well, what is an REO? Real estate owned. That means that the lender who made the loan took the property back after it goes notice of default, after it goes notice of sale. If it didn't get sold at the trustee sale, it didn't get sold at the courthouse, it's going back to the lender. This was obviously massive after the economic recession in 08, so 09, 10, 11, even into 12 and 13 a little bit. A lot of REOs, a lot of foreclosures, and ultimately short sales. That was a big, big, big thing. A lot of people think that's coming again, or especially homeowners. Hey, I'm going to wait until foreclosures hit the market and I'm going to get in there and I'm going to scoop myself up a foreclosure. Not so fast. Is that really coming this time? Don't forget, since 2008, not a lot of bad paper out there, meaning the mortgages that were written, not a tremendous amount of the bad debt, the same terrible mortgages that were written in the late 90s, early 2000s, and leading up to the 2007 crash in the mortgage industry, that bad paper is gone. The credit default swaps, gone this time around. So if there is a meltdown, it's going to be in some other part of the economy. Now, that can certainly have an effect. No question about it. If there's a big enough recession, even the homeowners who have super low interest rates, and don't forget for a second, 90% of interest rates out there, of mortgages out there, first lien position are below 5%. That's incredible. So many people refinance when the rates were so low. So, yeah, can they potentially be in trouble? Absolutely. If there's a big enough economic meltdown, even if you have 2.5% or 3% money on your house, plenty of people may not be able to hit that and pay that monthly nut, specifically because, well, prices rose so much. So anybody who bought a house in the last 2, 3, maybe 4 years paid a huge premium for it. So even at 3% money, that's a lot harder to make that nut, especially if they're being squeezed economically. And we know inflation's been here for a long time, and unfortunately it looks like it's going to stay with us for a while. So again, are there going to be the same amount of REOs and short sales that there were way back in 2008? Probably not, but I'm sure we'll see an uptick. You're already seeing that. Number two, MCA Decline. Mortgage credit availability. This should come as no surprise to anybody that the lenders are tightening even more. The mortgage credit availability is already on the decline. That means a lot of lenders are losing some of the loan programs that they're having. This is a big thing in the private money world. The private money and hard money lenders, especially to real estate investors, for the longest time were giving away the money. Here's a super low interest rate. Here's a very low origination charge. Here is almost all the purchase money plus all the rehab or construction money to do the project you wanted. Not so fast any longer. The past few months, those hard money and private money lenders have been pulling back in a big way. Now they want bigger down payments. Now they want to get paid again. The rate spiking up in a big way, and certainly the origination and the cost and the fees for those loans spiking up. So not only are you seeing in the conventional space, you're definitely seeing that in the hard money space. That bears watching. Number three, and this is a big one for me, HELOC on the upswing. Home equity line of credit. That's what HELOC stands for. Two things here to really think about. Number one is, if you just see it, that's a big thing because obviously, again, 90% of those mortgages, super low interest rate, below 5%. A lot of people don't want to touch that, but if they need to tap into the equity in their house, and we all know it's gone up a tremendous amount the past couple of years, they're turning towards home equity lines of credit. But I think it really bears watching how much of an uptick there's going to be, because that's a big economic barometer. Are people in trouble? Do they need to tap into the equity the same way because they saw that massive uptick? I mean, are they doing it because they're renovating their house and they're interested in just improving what they got or building an ADU? Or are they doing it because they're running low on cash themselves, so they're tapping into that? The big thing about these home equity lines of credit, though, to think about, they're not all just so easy to get. You can't just call up the bank and say, hey, my house is worth $3 million and I only owe $1 million on the first. Give me $200,000, $300,000, $400,000 behind it. Even though that's a massive cushion of equity, most people still need to qualify full documentation. Very different. There are some stated home equity lines of credit out there, and if anything about mortgage credit availability, this particular product, you might see a little bit more exotic product from some of the banks who are willing to just give it away without, no income, no asset, whatever it may be. But for the most part, they are still full documentation loans if you're trying to get one of those, and we'll see if people qualify for that. So all of this bears watching. A really interesting week, a really interesting time. Again, we're over 6% on that 30-year mortgage again, and we'll see what happens. Hope you join me next week, next Friday. We'll do it all again.